Hello and welcome back to our second video lecture dealing with Chapter 12, Differential Analysis, the Key to Decision Making. In this video, we're going to look at the first of many possible decisions we can make in a business dealing with differential analysis. So in this video, we're going to see whether it would be more beneficial to add or to drop a segment or a business line. Now, before we continue on with this video, it's important to remember the vocabulary words and the concepts that we learned in our previous video where we dealt with the key concepts. So, knowing what differential revenue is, differential cost, avoidable cost, which being able to identify which costs are relevant and which costs are irrelevant. So the first thing we're going to look at, like I said, is the add or drop decision. So there could be times in a business where a manager is going to have to make a decision whether they should add a business segment or they should add a product line, or conversely they should drop a segment or a business line. So what we need to do then is first determine the financial impact that the old segment had on the overall finances of the company. Okay, so when we're talking about add drop segments or add drop product lines, very important to remember that the main decision hinges on dropping an old segment or adding a new one is going to be primarily what is that financial impact. Okay, so in order for us to analyze the financial impact, obviously, hopefully it's obvious, we're going to have to analyze those costs. Okay, so let's look at an example here. Lavelle company apparently makes digital watches, and they have noticed a decline in popularity of those digital watches. Company hasn't reported any profit for several years, or I should say that product line has not reported any profit over several years, and Lavelle is considering, should we drop this product line? Well, in order to do that, we need to look at the financial impact of that. The easiest way to do it is going to be the contribution margin approach. Okay, basically when we look at the contribution margin approach, the first thing we have to do is compare the contribution margin that we will forgo or that we will lose if we drop that digital watch. Okay, then we need to look at the fixed expenses. What fixed expenses are we going to avoid if we discontinue this line? So the contribution margin approach, we kind of glazed over in our in the last video as far as the total approach, looking at the total approach and the differential approach. The contribution margin approach is the differential approach. Basically what we do is we just say, okay, we got a decision. We're either going to keep it or we're going to drop it. So let's identify all the benefits as well as the costs that differ between the two scenarios. So what we have here is the income statement specifically for the digital watches. Okay, we have the sales, the variable costs, we have the contribution margin, then we have the fixed costs. So we could see as of right now, the way it stands, digital watches, they're losing about 100,000 a year. We'll assume this is on a yearly basis. Okay, so what the segment margin says is, or I'm sorry, the contribution margin approach says is to focus in on that contribution margin of what we're going to lose. So if we get rid of digital watches, we're foregoing $300,000 in contribution margin. The next thing we need to do is look at our fixed costs and say, okay, if we get rid of this digital watch line, what fixed costs will go away? Okay, what are the traceable fixed costs that we can get rid of? Well, in order to figure that out, the problem has to tell us, right? And basically they told us that the fixed general factory overhead and the fixed general administrative expense will not be affected by dropping the watch line. So what that means is those costs are still going to remain regardless if we keep the watch line or we discontinue the watch line. Those fixed general factory overhead and fixed general administrative expenses will not be affected. They will still be there under each situation. So since they are present within both scenarios, they're irrelevant costs, right? They're irrelevant to us. We don't worry about them, okay? They go on to say that the fixed general factory overhead and general administrative expenses assigned to this product would be reallocated to another product line, okay? So we're not getting rid of those costs. They're still there. So right off the bat, those two costs, they're irrelevant. We do not include them, okay? They go on to say that, hey, the equipment that we use to make these digital watches, no resale value, no alternative use, okay? Should we drop the digital watch line? Well, again, in order to do that, let me go back one second. Bear with me here just for one second. Okay, so the general factory overhead, oh good lord, sorry about that, guys. The general factory overhead and the general administrative expenses, these costs don't go away, okay? They're still incurred even if we drop it, so we don't include these, okay? And then they said that the equipment has no other use. So look at the expenses that we're able to get rid of. So what we're going to do is we're going to compare we're going to compare using the contribution margin solution. We're going to look at all the differential costs. Well, we're losing $300,000 in contribution margin, okay? What fixed expenses are we avoiding? Well, if we get rid of them, we lose these expenses. We don't have to incur them. They're different. Those costs are different under each circumstance. Meaning if we keep the watch line, we incur those. If we get rid of the watch line, we lose those costs. We don't incur them, okay? So we see that we save $260,000 in fixed costs. So if we can compare the contribution margin of what we're losing by dropping the product versus the cost savings by dropping the product, we see that we're actually at a financial disadvantage. We're in the hole $40,000, okay? Based on that, we should not drop the digital line, okay? Now, we can do the total approach method, okay? This one's a little bit longer to do, and the differential approach is definitely the best route to go. But let's look at the total approach, or the total cost approach. The second way we can do this is basically by doing an income statement, okay? Well, we have the income statement of keeping the watches, and we have the income statement of dropping the watches, okay? So if we just look at just the revenue portion in the fixed, or I'm sorry, the variable expenses portion, we see that, okay, well, we forgo sales of 50,000. All these variable expenses we don't have if we drop the watch line. So we see that our contribution margin here is the 300,000 that we're losing, okay, just like we did with the differential approach. Then we look at the fixed expenses, okay. The general factory overhead, we keep that, right? Meaning that cost still occurs regardless if we keep the digital watch line or if we drop it. They said if we drop it, we still keep that cost, but it'll be allocated to another product line. Okay, so the cost is still there. The salary of the production manager. Well, if we drop the watch or the digital watch line, we don't have that cost. So we're saving 90 grand in salary of line manager. We do the same thing with the next expense, which is our depreciation. Now remember, depreciation is a sunk cost. Okay? It's a sunk cost. We never, ever, ever consider sunk costs. They're irrelevant to our decision. So since it doesn't differ between two circumstances or either scenario, we keep it. Okay? The next one we need to look at is our advertising. That stays, or the advertising is a relevant cost. Why? Because if we drop the digital watch, we save those direct advertising costs of that digital watch. Same thing with factory rent. That differs under each scenario. And so does, or actually that's it. We said total or general admin expense we keep, regardless of whichever situation we choose, that $30,000 remains. Okay, so we see that, oh, if we do this, we would earn 40,000 of additional product, by retaining the digital watch line. Okay, so we're looking at the differential analysis. We see this 40,000, and notice how our loss actually gets worse if we drop the line. Okay, we can see that right here. Okay, so looking at it through the two approaches, you have to see that there's a difference, right? The comparative, we're saying, hey, we're losing $40,000, so we don't want to get rid of the watch line, right? We said that in differential analysis. When we look at the total cost approach, like we have here, we can see that our net loss gets a lot worse if we drop the digital watch line. Okay, now there's one thing we have to worry about when we're looking at fixed costs. Okay, allocated fixed costs can distort the keep or the drop decision. Okay, let's say, for example, that Lorville's manager asks, why should we keep the digital watch segment when it's showing $100,000 loss, right? Well, we already saw that if we drop, if we drop the watch line, we're losing $300,000 of contribution margin that goes to cover fixed costs. The fixed costs that we save do not outweigh the contribution margin that we're losing. Okay, so again, the answer lies with the loss. It lies with those fixed costs, right? In a sense that we're allocating common fixed costs to our products. So when we're going to have to include the unavoidable common fixed costs, that makes the product line or the segment really look unprofitable. However, just like we saw, if we drop that product line, that's actually going to increase, or it's going to increase our loss, or if we're at a profit, if we have net income, it's going to decrease our overall net operating income. Make or buy decisions, we'll cover this in another video. I want to break these down into each video just to make them more digestible for you guys. So again, when we're talking about the keep or drop or add or drop decision, remember there's two things that we can do. We could do the differential approach or the differential cost approach, looking at the contribution margin and saying, okay, what are we losing? What are we gaining, right? We're losing $300,000 of contribution margin. What fixed costs are we saving? We compare the two. If we're in a negative like we are here, we're losing $40,000, we probably don't want to get rid of it, okay? The next approach we have is that total cost approach, or that with the comparative income statement. Again, a lot more work to do here. So get comfortable being able to recognize the relevant and irrelevant costs and benefits, looking at the differential revenue and the differential costs. Okay. When we come back in our next video, what we're going to do is we're going to look at the make or buy decision, and guess what? We're going to do the same thing in a sense. We're going to look at, okay, what benefit and cost differ between the two scenarios. Let's monetize that, and let's figure out if we should add or drop. Let's figure out if we should make a product or we should outsource it and buy it. So tune back in for that video.